All right, let's get right into it. Today, we're putting Intuit on the stand. The stock has been taking an absolute beating, but here's the mystery. Is this a falling knife you shouldn't touch, or is it one of the biggest golden opportunities in the market right now? We're going to run a full forensic audit, digging into the hard data to see what's really going on.
And wow, this is pretty much the scene of the crime. I mean, look at this. On one side, you've got the NASDAQ composite, the broader market, just soaring to all-time highs. But then you look at Intuit, and it's a bloodbath. The stock has absolutely cratered, down almost 43% this year alone. It's wiped out nearly 5 years of gains. The contrast is just brutal.
So that leads us to the $1 million question, right? Is the actual business broken, or is the market just in a full-blown panic? That's what we're here to figure out. And hey, if you want to see us crack this case wide open, do me a quick favor, hit that like button and subscribe. It really does help us dig into more stories like this one. Okay, so where do we even begin? Well, like any good detective, you start by following the money. So for a minute, let's just completely ignore the crazy stock price and look at the most basic thing, a company's revenue. Is Intuit still actually making any money? And whoa, our first clue is a real shocker. Far from being broken, Intuit's business has been an absolute compounding machine. Just look at these numbers. Revenue has rocketed from about $7.6 billion in 2020 to a projected $18.8 billion in 2025. The business has more than doubled in 5 years, while the stock is in the gutter. That is a huge disconnect. And you know, it's not just about that top-line growth. It's about how much of that money they actually get to keep. That gross margin line, sitting steady around 80%, is just incredible. It means for every single dollar they make, they hang on to 80 cents as gross profit. That kind of pricing power tells you their customers need what they're selling. And that strength, it just trickles all the way down. The company's whole efficiency engine is just humming along beautifully. Both the operating and EBITDA margins are not only healthy, they're actually getting bigger. So, in simple terms, the bigger Intuit gets, the better it gets at making money. The business scales, and it scales really, really well. So the income statement looks amazing, actually. But we all know a great business needs more than just profits. It needs a rock-solid foundation. Let's dig a layer deeper and see if this thing is built on sand or on solid rock. Let's check out its financial strength. And this right here says it all. You can talk about profits all day, but cash is king. And let me tell you, Intuit is sitting on a throne of it. We're talking about free cash flow, the real cash left over, set to blow past $6 billion this year. That's nearly tripled since 2020. The cash machine is speeding up while the stock is hitting the brakes. It just doesn't add up. Okay, I want you to burn this number into your brain, 52.5%. This might just be the most important piece of evidence we look at today, so what on earth is it? This, my friends, is Intuit's return on invested capital. You can think of it as a report card for how smart the company is with its money. And to put this into perspective, the average S&P 500 company would be thrilled with 15%. Intuit is generating over 50%. This isn't just an A+, this is an elite world-class number that signals a massive competitive moat. And that fortress? Well, it's built on a heck of a solid balance sheet. I mean, they've got nearly $6 billion in cash, which almost completely cancels out their $6.5 billion in debt. And get this, because they're gushing over $6 billion a year in cash, they could pay off their entire net debt in, what, about 5 weeks? That's just an insane level of financial security. Okay, so the business is a powerhouse. We've established that. It's growing, it's insanely profitable, and it's financially sound. So what is management actually doing with all that money? This brings us to the motive and why this story gets really interesting for long-term investors. Well, one of the biggest things they're doing is buying back their own stock. And they're doing it aggressively. You can see the buybacks are just soaring. Every time they do this, they reduce the total number of shares out there. So with fewer slices of the pie, your slice as a shareholder just naturally gets bigger. And here's the wild part, the thing that most people miss. This stock crash is actually fantastic news for long-term owners. Think about it. With the stock down almost 50%, every dollar the company spends buys back way more shares than it could before. It's like your favorite company is having a massive half-off sale on itself. The market's panic is literally making patient shareholders richer. And on top of that, they're literally paying you to be an owner through a dividend. That dividend has doubled in just 5 years. And look at that payout ratio. It's using less than 20% of their free cash flow. It's incredibly safe with tons of room to keep growing for years to come. So we've looked at the business from almost every angle. Revenue, profits, cash flow. The evidence is just overwhelming that the company is thriving. But that leaves one final crucial question. Is it a good deal? It's time to render our final verdict on valuation. And the verdict is in. Based on its price-to-book ratio, which is a simple way of comparing the stock price to the company's assets, you can buy a piece of Intuit today for cheaper than you could have had at any point in the last 5 years. Let that sink in for a second. The business is twice as big and fundamentally stronger, but its price tag is at a multi-year low. So let's just sum it all up. Let's put it on a scales. The bull case is all about the fundamentals we just walked through. Record revenue, record cash flow, elite returns, a growing dividend, and a bargain valuation. And the bear case? It's pretty much just feelings. It's market sentiment. The stock is down, so people are scared. It's a classic battle of hard data versus human emotion. By the way, is there a company you're dying to see us analyze like this? Let me know in the comments below. And that really brings us to our final takeaway. All the evidence we've gathered points to one single conclusion. The business of Intuit is stronger than it has ever been. The stock, on the other hand, is panicked. Our little forensic audit here suggests that for anyone with a long-term view, this huge gap between the health of the business and the price of the stock, well, that's pretty much the definition of opportunity.
So I'll just leave you with this final thought to chew on. When a truly world-class business goes on a massive sale, is that a signal to panic and run for the hills? Or is it a signal to be greedy when others are fearful? That's the real question, isn't it? If you found this explainer valuable, please don't forget to like, share, and subscribe for more deep dives. Thanks so much for watching.